Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with Gary Mishuris. How you doing today, Gary?
Great. Thank you for having me.
Good. So Gary, before we dive right in, tell us a little bit about your background. How did you get started with investing, and how did you get started, in kind of the value part of the field?
Sure. Came to this country as an immigrant from Russia. Grew up in New York, with a single mother, and saw her put all her savings to mutual funds as soon as she got a job. So that was my first introduction. Then I was studying economics and computer science at MIT during the last bubble, and Warren Buffett happened to come and talk on campus at Sloan, which was the business school there. And I was starting to speculate in tech stocks. And at the time, thinking I'm smart and I'm studying these subjects so I can figure it out. And I was lucky that I bought, I think, the only tech stock that went down in 1999. And happened to listen to Buffett, who I didn't really know much about him, just that he was a wealthy guy, successful investor. And here was this gentleman talking about long-term intrinsic value, margin of safety, things that made intuitive sense but didn't know at the time. So that was kind of my conversion to value investing. And I was fortunate to start a career at Fidelity, where I had a great mentor, a gentleman by the name of Joel Tillinghast, who manages a low-price stock fund. Is just a terrific long-term value investor. I think he was Morningstar Manager of the Decade at one point. And things began from there. And fast forward 20 plus years later, I'm kind of still practicing a concentrated long-term value approach.
So that's great. I mean, I think it's interesting that Warren Buffett was your inspiration to getting started in value. I think he's inspired a lot of people to get in value, and yet in the last 20 years, value has been out of favor. It's been one of the few areas with some pockets of success, but generally it's kind of been out of favor in comparison to growth. So how have you been able to weather that when, all people want is growth stocks?
Yeah, and it's a good question because there have been a lot of some value investors have converted, right? Where they've redefined value investing very broadly into basically buying anything, and saying it's undervalued, which is not wrong. It's just, it's a very different interpretation of value investing than what's meant by the term traditionally. Other people have stuck to their guns. I'm in that category. I think people misunderstand value investing as buying statistically cheap stocks. And I think that maybe that worked, 30, 40 years ago. I think the markets are more efficient, and I think you do need to pay a lot more attention to the quality of what you're buying, right? And I think that's where the critics are right, that like the value investing of buying low price to book or something probably isn't going to result in massive riches. But I think that where they're wrong is that the answer is to start buying things at 30 times sales or 40 times sales on hopes and dreams that this is going to be the next Amazon. And I think that's where people get in trouble, and most of them end up losing a lot of money. So how I weathered it, I think, first of all, I have just, probably an insanely high tolerance for pain, because it has been painful to be a value investor, right? It's kind of like you have the fear of missing out. You have your neighbors who are getting rich. You have people, everyone kind of dunking on value investors, saying, you don't get it. It's all different now. The pace of change is different. Technology is there. You can't do what you're doing. And part of it is just having a really rigorous process where I'm an engineer by training, and you're trying to do something in a systematic, repeatable way, and that keeps you out of trouble.
Yeah, it's interesting. What you're saying, I've heard a lot of, people who've changed from value investor to the new value investor, which is basically a growth investor, like you're alluding to, but they're calling it value because they have to, right? I mean, who wants to invest in a value stock or a value fund when you can just buy FANG stocks and they always go up every single year? I mean,
Right.
So, we've had pockets of where value has outperformed, right? In the early 2000s, and I would argue now, specifically. What do you attribute that to? Like, is there kind of a greater macro force at play that is allowing value stocks to do well during certain periods and not do well in other periods?
I think a lot of it has to do with just the degree of gambling speculation, right? Because growth stocks, and again, I think value versus growth is a false distinction, but I think you know what I mean. What I mean when I say that, high expectations companies, glamour companies, whatever you want to call them, they're always a sexier story, right? If you take, I don't know, a glass container manufacturer trading at a 15% free cash flow yield, where the story is it's going to make that amount of money every year, that's not an exciting story, right? But if you tell a story about, I don't know, electric vehicles or whatever it is, some way that the future is going to change, that's a much more exciting story. So I think whenever there is more gambling, and I'm a student of market history, there's always gambling. It comes in cycles, and frequently it's caused by easy money. Like the easy money starts, and then it feeds on itself. Like a few people get rich, they tell their friends, FOMO kicks in, other people want to do it, then people start using margins, they start using options, and heck, my mother is a computer scientist, and she was asking me if she should start day trading professionally. I'm like, Mom, are you crazy? Like, really? Like, are you like? She's like, well, So her friend, so she has a master's in math, by the way, and her college friend called her, said, I had a 50x return over the last 5 years. Now, how's your son done? And I'm like, I think I've doubled my money, a little more. I don't, right? But it was so. On the one hand, you have all these examples that people are. Oh, so how does it start? Is you have stories, you have kind of animal spirits, you have gambling mentality, and it feeds on itself until it doesn't, and nobody can tell you when it ends. But it implodes almost the same way every time because it's the same human psychology that's in play both in the rise of the bubble and in its implosion. But you just can't tell. Like Alan Greenspan, 1996, right? Irrational exuberance was used. Well, a lot of value managers were fired between 1996 and 2001 when the bubble popped because I can tell you, I was at Fidelity and they had just fired their value manager and replaced them with a growth analyst promoted to take over their funds. That's how bad it was. And I'm sure you remember that.
Oh yeah, no, I remember. I started in '99, so I
Yep.
I got to see. I didn't get to see any of the upside. I got to see all the downside. So it gave me a little. I think it was a good start. It was a good framework for me to learn because risk management is not really used very well in Wall Street. So I had to learn that day one, which which was a great lesson, even though it was very painful.
Well, you make a
So
good point. Just to kind of piggyback off of that is how many market participants right now actually have experienced serious pain, right?
yeah,
You said you started with the like pain, and that's good because I think that people who start in markets like that, they learn. They learn that risk management matters. They learn that you can lose a lot of money. And the people who start when the markets are only going up, they get this false reinforcement, which kind of feeds their ego and makes them think they're stock picking masters because they're buying stocks that other speculators are bidding up and they keep trading among themselves thinking they're all like God's gift to, stock picking. And they just never get that negative feedback that humbles them and forces them to learn real investing.
yeah, you make a great point because I remember in the late '90s something very similar to what we're seeing now, where I'm getting calls from people. Oh, do you think I should be a professional day trader? Just like you said
Yep.
with your mom. Like I, I understand. Like it's easy money when you hear the news saying, "Oh, you just buy these meme stocks and they go up, a few thousand%, and you could be a millionaire." I've had a handful of clients, very smart people, who, some of them were maybe not, some of them are computer scientists, but they're like really good at math, really smart people, and thinking, "Oh, I'm going to start day trading." I'm like, I mean, I know professionals that don't want to do that. They could. I mean, it's a different lifestyle, but that's a totally different story. But the reality is, people just think it's too easy, and the same thing started to happen with real estate, right? And
Mm-hmm.
people said, "I'm going to quit my job and just trade real estate and buy real estate and make lots of money." It's like, it's a sign of the top. But to me, it seems like raising interest rates is the time when that kind of breaks the back of this kind of behavior. Each of those times it seems to be what's caused it. So how does rising interest rate environment affect value stocks? Because that's basically what we're experiencing now and probably will for the foreseeable future.
Well, there's two dimensions, right? The first dimension is mathematical, right? for if you look at a company with long duration of cash flows, and a growth company has long duration. Think as a bond, right? If you have a company with a 15% free cash flow yield, its cash flows are close in. If you have a company at 2% free cash flow yield, its cash flows are further out. And mathematically, when you discount them, lower rates favor growth companies. Just purely math, right? You can't argue with it. A company with a long duration of cash flows increases percentage-wise more if you drop the discount rate. But nobody, I mean, let's be honest, how many people are actually doing real DCFs, like with real inputs? So that's the math of it. Now, the sentiment of it is, and I think there is part A and part B. Like part A is, as long as money is easy and there is speculation, it reinforces itself, right? And when money tightens, the feedback loop breaks, right? And essentially, like, why do people buy a lot of these stocks? Because they went up yesterday and last week and the week before that. And when they went down yesterday, they start to get scared. And when they went down for a week, they start to sell, right? So it kind of feeds on itself. The other thing, and again, I'm a microeconomics guy, so like you won't hear me talk about the Fed very often, but the Federal Reserve was clearly trying to use the wealth effect to prop up demand, right? They wanted people to feel flush, look at their brokerage statements and say, wow, I made a lot of money in the market. I'm going to go buy a house or a car or a refrigerator. And that was their way. So they were very much on board with, they were the pumpers, right? They were literally the pumpers, except without the dumping. And so now they actually like realize that they messed up their day job, which is not doing all this crazy, political stuff, but actually like controlling inflation and making sure it doesn't get away from them. And they're actually incented now to like reverse the wealth effect. So for the longest time, you had like the house rigged against rational investing because they wanted all this stuff to happen, not like explicitly, but almost close. Because remember, in 2020, they bought junk bond ETFs. Like, it's unclear to me what that has to do with anything. Supposedly that was for orderly markets, but they were pretty darn close to explicitly manipulating security prices. And now they're stepping back from that, and now they're kind of tripping all over themselves to get back to a more rational policy. And as a byproduct of that, that whole easy money, spiral is working in reverse.
Yeah, I mean, I think the junk bond market specifically, I mean, I know a lot of smart people have identified a black swan event in the high yield bond market specifically because you have more and more companies who are borderline junk, triple B, and, a recession would cause who knows if the rating agencies, they haven't done a great job over the years, but let's say, they start moving to junk that causes a cascade. I mean, I understand why they did that, but you're right. So let me ask you this question. So are you specifically in US based or are you international? Because there's a ton of value out there in places like Japan. I've seen some great research there. So where are your limits and where you look at your portfolio?
I look globally, but I look globally where there's rule of law, English financial statements, and where the markets are the primary determinants of business outcome, not the government. So I don't invest in China. I don't invest in Japan. I think it's investable, but I think it's outside my circle of competence. So primarily we're talking about US, Canada, Australia, New Zealand, European countries. I'm definitely never invested in Russia, never will. Just structurally, I think now it's off the table for most people, I think. But I remember people coming to me and say, "Hey, you grew up in Russia. What do you think about this stock? It's a 3 times earnings." But like, yeah, but have you tried getting any money out of Russia? Like, I think one guy tried, and he had to be like flown away to safety before the Russians almost carved him up into pieces. So yeah, so I think I try to stay within my circle of competence. But you're right. I think the U.S. had a much bigger bubble than other markets, and there are like I do hear about like values, say in South Korea or something like that. But and that's a market I'm thinking about, but I'm not yet sure it's within my circle of competence.
Okay, no, that's fair. I think it's really important to understand what your circle of competence is, right? And I think, like I said, I've seen a lot of research on Japan that alludes to the fact that it's cheap. Yet you talked about having a government influence over the market. So what does the Japanese government own like 90% of publicly traded securities or some crazy number. So not suggesting that's a good idea.
Well, it's also cultural, right? When you have companies and their stated purpose isn't to make profits, but it's to perpetuate themselves, keep the employee base stable, things like that, keep a lot of cash, which you can make an argument isn't that different from like West Coast tech companies. But you see a lot of these cheap Japanese companies and they have an ROE of 6 because they hoard the cash, they don't allocate capital well. And so you kind of start to say, well, it's cheap, but if those things don't change, is it truly undervalued?
Yeah, that's a great point. Um, so, you mentioned you really pay close attention to quality. How would you define quality? Like, what are you looking for when you're looking for quality?
Yeah, so I think it's important to remember that as investors, we're trying to predict the future. And that's true whether you're buying a stock for 1 times earnings or for 100 times earnings. You always are trying to predict the future. And so, what does it mean for me to have a high quality business? It's one that's predictable and has a relatively narrow range of future economic outcomes. And I think when you think about what predictable means, like maybe it's easier almost to talk about what it means to be unpredictable. So think about markets where there are rapid market share swings, right? So think about Nokia was the leader in cell phones at one point. Motorola was another. BlackBerry. So there are all these vicious product cycles where the performance over the last 10 years is not really a good prologue to the future of many of these companies in these markets. Other examples are where there's just technological leapfrogging, right? You can come up with a technology that obsoletes an existing technology. So I like businesses that are resilient to obsolescence, where market share changes slowly, where there's a structural reason. Again, I'm just using glass bottles for a second. Now, one of my investments, they make glass bottles. Well, that's been around for 100 years. I teach a value investing seminar, and one of my students pointed out that in one of the early security analysis editions, Graham used this company as an example. So, it passes the test of time. Sure, there are switches between glass and aluminum and so forth, but they're very glacial and gradual. And no matter what's going to happen tomorrow in China, Russia, the Fed, people are going to drink beer, people are going to drink wine, maybe a little bit more, maybe a little bit less. So the range is pretty tight, and barriers to entry are pretty high. You have to be within a certain distance of your customer. So you can't just magically have someone in Silicon Valley come up with a magical device that's going to transport, wine, teleport it to your home. So all of this stuff makes it very hard for the business to change in unexpected ways. So that's the kind of stuff I look for. And that to me is business quality. And then on the other side, there's management quality, because you can have a good business, but if you have crooks running it, or if you just have complete incompetence who are taking the free cash flow stream and throwing it away and burning the money through dumb acquisitions or self-dealing with things like that, it doesn't matter that the business is predictable, because you're not going to get the cash flow stream. So I think you need a predictable enough business. It doesn't need to be perfect, and you need honest and reasonably competent people running it, and then you have quality.
Okay, no, that's great. I like that. So how do you determine the price you're willing to pay for a business? Because obviously prices have gone way up over the last 10 years. And as you alluded to earlier, there's a whole generation of people who've never seen bad times, right? Anyone who's been in the markets for the last, 14 years hasn't seen bad times. Anyone
Right.
who's been in the market for the last 20 years probably hasn't seen bad times. Everything just goes up, right, according to them. And we have a whole generation of people that are retired or gone that have not even seen the 70s, which was a really bad time. And yet, some would argue that, like myself, that we're going to kind of repeat the 70s in a very similar manner. So how do you look for price, in a time when, I don't know, let's just say the stock market's going to start to enter a bear market? Like, how are you looking at price for the businesses that you're willing to pay?
Sure. And I guess my starting point is I'm an absolute value investor. And what does that mean? So the relative value approach is saying, well, look, I'm going to always be invested, and I'm going to buy the tallest midget if there is no really tall stocks, right? If everything is 20% overvalued, then if something is 5% overvalued, then terrific, right? So that is not my approach. My approach is I think in terms of opportunity costs, and I don't intentionally make an investment unless I think I'm going to have a 12% IRR. Now, what does that mean? Obviously, I'm going to make mistakes, so I'm obviously going to have lower returns than that on a realized basis. So I'm human, and I'm going to make many mistakes. The point, though, is that I'm not intentionally committing capital unless I think I get that low double-digit rate of return. So I use a DCF with a 10% discount rate, and the margin of safety in my mind comes from both the discount to intrinsic value and also from the quality of the business. So I grade quality 1 through 5. Obviously, it's not meant to be precise, but just to give it kind of buckets. So 1 is best, 2 is above average, 3 is average, 4 is below, and 5 is worst. I first of all eliminate 4s and 5s. So I intentionally don't invest in below average businesses because they're just too hard to predict at any price for me. I know there are other people who disagree and they say there's a price for everything. And probably if you're God, there is a price for everything if you know the future perfectly. But my argument is that for really tough businesses, it's tough. And I'll give you a quick story. When I was a young analyst at Fidelity, I was covering specialty chemicals. And there was this company, Faro, FOE was the ticker. And I thought, yeah, it was worth about $40. It was normalized mid-cycle earnings of $2.50, average grower, slap some 15, 16 times PE on that, and there you go. Well, you know how people always sweat whether company beats earnings by a penny or a nickel? Well, I look back, and that company's actual mid-cycle earnings ended up being 25 cents. So 1/10 of what I thought, right? And so when you can beat that off, and despite all the resources in the world, all the access to management in the world, it's just humbling. And it says, well, what did you do wrong? Maybe what you did wrong is you started with too tough of a business that just has too much of a variance of economic outcomes. So I eliminate the worst stuff. And then between the best, above average, and the average, I have a sliding scale, meaning, if I'm calculating the intrinsic value using a 10% DCF, for the best businesses in the world, I'll be happy to buy them at 75 cents on that dollar of value. For that next tier, the above average ones, it's 65 cents. And for the average businesses, if I even go there, it would be 55 cents. And what that translates into is for the best businesses, if I were to buy them and hold them forever, like Buffett does, that 75 cents in the dollar maps to about that 12 IRR of the cash flow stream. And on the other extreme, the 55 cents for the average business maps to a 15, 16% IRR. So I try to basically demand a higher rate of return based on quality with a minimum quality threshold built in.
Okay, so no cigar butt businesses is what you're telling me.
No, I mean, there once in a while will be some special situation where, let's say, they're below net cash, and I've had 1 or 2 of those. By the way, another funny story is, when I was a very young associate, a more experienced analyst came to me and says, Gary, I have a great PA idea for you. It's the company ticker. It was MPH, miles per hour. They were a competitor to IndyCar racing. They were basically running a race team business that had economies of network, and the teams were leaving. I'm not an expert in racing, but there's like IndyCar and stock car racing, so two different types, and their type was losing out, but the stock was trading below cash. And so my friend said, listen, you can't lose, Gary, because it's trading below cash. Either they fix the business and it's worth a lot more than it is trading for now, or you get the cash. How could you lose? Luckily, I was poor and didn't have any money other than $10,000 in college debt because we did lose. So how did we lose? Well, of course, the management team didn't want to just give you the cash. So they kept trying to fix it until they ran out of cash, and voila, you lost because they failed to turn it around. Now, interestingly enough, almost 10 years later, a lot of smart value investors fell for the same trap, and I learned from my mistake or my potential mistake with Blockbuster, right? Blockbuster was a cigar butt. There were a lot of, I'm sure you remember, smart value guys and gals saying, look, the DVD library alone at one point is worth more than the entire business. So you have this library and you have the business, and if they turn around, you make a lot of money. If they don't turn around, you have the inventory and it's trading for below that. Well, what did they do? They try to fix it by going to video games. They burned through all the money and they went bankrupt, right? So these cigar butts require a very unusual management team, which is one that's basically willing to put themselves out of a job and have the integrity to give shareholders the money back and to also have a limited ego in the sense that they are willing to admit that maybe this is too tough to turn around. And a lot of people, even honest people, again, I'm a big fan of behavioral finance. They're highly overconfident. And even if they're honest, they might say, listen, I'm a great CEO. I went to Harvard Business School. I can turn this around. Just give me more time. Give me more capital. I'll do it. Right. And then voila, the cigar butt aspect is gone. Someone else took that last puff for you. And all you have is a soggy piece of unpleasantness left for yourself.
So that's great. I appreciate that. Those are good examples. So I remember 2008, looking at value stocks or value funds and noticing a lot of them had Countrywide, WAMU, and a bunch of other quote unquote value stocks because they'd gotten so cheap that, hey, why not? They're value stock. And of course, those stocks kept going down. So how do you prevent in a situation like this that happening? I mean, I know you're focused on quality, but I would argue that those are some quality companies. I mean, I guess you could obviously argue after the fact they weren't, but they're really high grade companies that maybe you wouldn't have known the management was questionable on Countrywide or things like that. Because sometimes there's just things you just don't know, right? Like you didn't, like I would say a handful of people knew about the housing bubble or really they knew about the financial system bubble, which was going on, but very few. Everyone else thought things were normal. So how do you protect yourself against things like that?
So I think it's a great question, and it also relates to a question of when can you make something a really big position, or like you come in the morning, you look at the stock prices, and one of your stocks is down 50%. Like, which ones would you say, okay, I'm very confident that almost no matter what happened, I can, double down on this investment, versus which ones they go, actually, this might be, the first of many legs to bankruptcy or zero, right? And I remember very vividly arguing with my team. So I was co-managing a large value fund back at a prior employer, and we were talking about Bear Stearns as it was spiraling down. So like, and by the way, a very well-known manager who I won't mention, who's been very successful, pretty much ended his career, or at least ended a portion of his career, doubling, quadrupling down onto these financials that went under essentially. Which reminds me of an old joke about a portfolio manager who lost half his fund in a 5% position. How? Well, it went to 2.5, but he doubled down, it got cut in half, right? You get it, right? So there's a couple of mental models here. One is reflexivity, right? So a stock is reflexive if its value actually goes down when its price goes down. So what would be an example of it? An example would be like Bear Stearns or a run on the bank, right? When customers see that the stock price is down, they have less confidence in the business, so they switch. I don't know if I'm sure you remember people were lining up to leave the Bear Stearns prime brokerage, for example, for safer havens, and so forth. So the price itself becomes a mechanism of changing the value, which is kind of a George Soros idea from Alchemy of Finance. And then the other thing is financial leverage. Like no matter how good a business is, if it's levered enough, you could have a situation where it's what I call path dependent. Meaning if you think about the problems, if they take a very sharp V shape, and that V is deep enough, that equity might be worthless. The business might not be worthless, but you just won't be the owner. You'll be knocking on the door from the outside, say, hello, let me back in. And the bondholders will be like, nah, we got this. We're the new owners now, right? So you can have a decent business or even a better than decent business wiped out with undue leverage. So you can't really go all in on reflexive stocks. You cannot go all in on companies with mountains of debt, even if they're good businesses, because if the unforeseen happens, you might get wiped out. So you have to guard against those. That doesn't mean you can't have a small position in them. And for me, I'm pretty concentrated. So for me, a small position is 5%. But you can recover from losing 5%. But you cannot recover from multiple double-digit position losses. And so I think where some of those investors went wrong is they let hubris guide their position sizing, and they were just vastly, vastly overconfident. And then they complain about, well, we got screwed by the government or whatever. Just like the long-term capital management guys were very smart, they got screwed by Goldman Sachs. So there's always someone They're like whenever someone is acting the victim, it's always suspicious because the point of risk management is to not be a victim, right? You might lose a little bit, but if you're doing risk management properly, you shouldn't allow yourself to be in a position where the Fed doing this or Goldman Sachs doing that is going to wipe you out.
Yeah, no, you raised the question of when to make it a big position. So how do you decide on position sizing, and how do you decide when you feel comfortable enough to make a position a large position, because it sounds like you have some really concentrated positions.
Yeah, so for me, small is so I have three position sizes: small, medium, and large. Very simplistic: 5, 10, 15%. Like 15 is pretty rare. And so to be a larger position, cheapness is not enough. You have to have above average quality. So if you remember 1 through 5, with 3 being average and 1 being best, only ones and twos in terms of quality are candidates for large positions. You cannot have a very levered balance sheet. Maybe a turn or two of debt maximum. So we're talking about debt to EBITDA is 1 or 2 times for most businesses. We're talking about A kind of level credits as opposed to triple B or lower. And essentially, you have to have relatively low downside. So I size my positions not based on my expected value or my upside, but based on the downside. There's some like a mental model I call portfolio at risk. And what portfolio at risk means simply is take your position size and multiply it by the downside to your worst case. So let me give you an example. Let's say you have a position where if you're wrong, you're going to lose 100% of your money. Well, and let's say you make it a 5% position. So your portfolio at risk is 5 times 100. So it's a 5%, right? Let's say you have a position that you size as 15%, but your downside to your worst case is a third. So now your portfolio at risk is again 5%, so 15 times a third. And again, in both cases, you're risking 5%. So it's those positions with low downside that you can make large positions and still have a manageable portfolio at risk on each position. So I use downside really for position sizing because I think a lot of people go wrong in trying to reach for the highest possible return. And I have a different approach. I have a safety first approach where my goal is to make sure that we don't lose our money and then make a good return. It's not going to be the best return, but I'm also taking what I believe to be very low risk in getting there. And I have all my family money in the partnership, and I would much rather have a good, safe return than a chance at a great return and losing a bunch of my money.
No, I like your approach. So we have a very similar approach. So we call it risk management first. What do you attribute to the fact that so few people on Wall Street focus on risk management? I mean, everyone talks about it, oh, risk management is important, but very few people actually build it in, like what you're talking about, into their portfolio. So what do you attribute that to?
Well, think about this from like a personal business point of view or career point of view. So who gets to go on CNBC and like mouth off on how great they are? It's the people usually who have extreme results, right? How do you get an extreme result? You take a big directional bet, right? Now, if you say, well, and obviously the world can take an infinite number of paths, but let's say there's two possible branches, A and B, right? Um, if you put it all on A and A hits, you can go on CNBC and self-promote and all of that. I'm not saying that that's what you should do, but you can if you're unscrupulous. If you put it all on B and B hits, you get the point, right? If you put it all on A but B hits, nobody's heard of you, and then you try again on something else, right? But let's say you have a thoughtful approach. You say, I want to have a portfolio that no matter whether A or B hits, you don't do too poorly. You have to pay for that. It's not free. There's no free lunch. There's no free insurance. You have to sacrifice some of the return if you're going to be right to cover your bases if you're going to be wrong. And so what happens is no matter whether A or B hits, you never have the best returns. So you're never the person who has the 30% per year CAGR over 10 years or something like that. And you can talk about risk management until you're blue in the face, but you're not the person self-promoting on CNBC. Now, again, I don't want to be self-promoting on CNBC, but for the people who build their businesses that way, they take extreme bets, and they essentially free roll with their customers' money. because the customers don't understand that if they didn't get lucky, they would have had a serious loss because they're not as involved in the management of the portfolio. They don't understand. I had a client who has some of his money with me and some with another wealth management firm, and he said, Gary, they're doing something weird with options. Can you take a look at this for me? And I said, sure, not a problem. So he said, so what they're doing is they're selling put spreads on the S&P. That basically means that they're collecting a small yield, which, by the way, is terribly tax inefficient. It's all short-term gains. And most of the time, they just get the small premium. But if there's an extreme sell-off, they will lose a huge amount. Now, since most of the time there isn't an extreme sell-off, all the client sees is the profits, right? And he's like, oh, these guys are minting me money. They're getting this free money. Well, it's like saying, look, there's a sleeping alligator with an open jaw and a $20 bill, and some guy keeps reaching in and snatching the $20 bill, and he does that 9 times out of 10, except there's a 10% probability that the alligator snaps his arm right off. Well, is this person a really skillful $20 bill snatcher, or they just get lucky that the alligator didn't just wake up, and the 10th time they're going to be missing an arm, right? And I think it's more of the latter as opposed to because nobody knows where the S&P is going to go on a 2-3 month basis. Like you don't, no offense, I don't, and neither does the wealth manager selling those put spreads. So that's a great example of that snatching nickels in front of a steamroller strategy, which to a client who's not sophisticated necessarily in that approach looks like that manager is earning excess return, while all they're doing is taking on huge risk.
Yeah. So we're going to get close to wrapping it up here soon, but I have a few more questions. So one is, the value investing has evolved over the last, 100 or so years. And, I think it started, they were talking about cigar butt investing, like we talked about, and it's evolved quite a bit. So can you talk a little bit about that evolution and where you see potentially any future evolution going as the markets obviously consistently evolve?
So I think the biggest evolution is that the markets have become more informationally efficient. That's not, controversial. When you read Graham or early Buffett, you could, an edge. Buffett's edge used to be he would go to the library earlier and read the filings before other people got them, or something like that, or get the annual reports first. That just doesn't exist anymore, right? Nor should it in an efficient market. The next thing is, I think, the pace of disruption, as people always say, has accelerated. What does that mean? That means that disruptive companies are probably arising faster than they did 40, 50 years ago, and they're possibly disrupting more established companies faster. So all that suggests is that you need to spend more time on qualitative analysis as a value investor and not just stop at the it's cheap. Like it used to be, if it's cheap, oh, pretty good chance it's undervalued. In today's world, if it's cheap, the first question you should be asking yourself, well, like everybody knows it's cheap. What do people think is wrong with this to make it cheap? And why do I disagree? So the analytical edge becomes important. But the other edge that I think you can't arbitrage and cannot get more efficient is time horizon edge. And I think a lot of value investors talk about it, but I think it starts with both. I mean, let's assume you have the right mental mindset to be a long-term investor. But if you have clients who are going to sell, redeem on you, right? During a tough performance stretch, your time horizon doesn't matter. It gets shortened to your clients. So I think selecting and partnering with the right clients is super important, because having the time horizon edge is really crucial in the world that's more efficient, because you can ask the question of, what does this business look like in 5 years? What are its key economic characteristics? What is it worth? Not where will the stock be in 5 months? Will they raise guidance for next year? Which is what the vast majority of market participants are asking. And so I think you have to play where others aren't. And I think it was Seth Klarman or someone else who came up with the idea of the yield curve for equities, right? So the yield curve for bonds usually is not right now necessarily, but upward sloping, meaning the longer the duration, the higher the yield most of the time. So the idea is that if you have a 3, a 5, or even 10-year time horizon, you're likely to get excess returns versus someone who is playing in a very crowded 6 to 12 month space that everybody is playing in. So I think those are some of the changes. I don't think that inefficiencies are going to be gone, because human psychology hasn't changed. Like I'm really a big believer that inefficiencies are there because we have this reptilian part to our brain that causes us to overreact, to get emotional, to do all these things. That was true in 1920s, it was true in the 60s, it was true in the 90s, and it's true now. And it's going to be true 30 years from now. And that's why I think the opportunity, you have a calm, rational, repeatable process that you're executing, that's, I think, where you can get a big edge.
So as we kind of wrap it up here, you mentioned, you focus a lot on behavioral part of investing. What are some of the behavioral challenges that that investors, especially value investors, should be aware of as they're looking to, invest in value uh, investments?
Yep. So I think that if I were to leave those folks who are listening right now with a takeaway is you cannot seek validation from the market. That's at the root of almost all behavioral patterns in investing, where deep down the person is insecure. They're seeking validation, and that validation is a stock they bought going up, their portfolio beating the market over some stretch of time or something like that. You have to absolutely detach yourself from seeking validation in your outcomes, and you have to realign your thinking into seeking validation in how well you perform in terms of executing your process. And that's very hard, right? Most people, if they think, well, let's say I did everything right, but the stock went down for 3 months, it hurts. Theory says, well, you should be happy. Hamburgers went on sale. I'm going to buy more at a cheaper price. That's the theory. The truth is, for most people, it hurts. And that's human. But you have to really train your mind to redirect that pain and give yourself a different feedback loop. Because if you're going to get the feedback loop that you need confirmation as a human being or as an investor from the market is going to chop you up and spit you out, and it's brutal out there. So you need to have that, and I think having the right mentors, having the right friends in the business, whether you're an individual investor or someone who is a professional investor, having a support network of people who you trust to be sounding boards to say, hey, listen, am I going crazy here when your stock goes from 10 times earnings to 5 times earnings to 2 times earnings? Am I insane? Or is my process still sound? Having someone you trust, 2 or 3 people in the business to run things by, I think is crucial as well, to kind of not let the market be your final judge in the short term.
I think that's great advice. It's probably one of the hardest things for people to do, but great advice nonetheless. Well, good. Well, Gary, I really appreciate you coming on the show and sharing your wisdom with us. We'll definitely have you back on the future. Where can people find more about you?
Sure. I have 2 sites. I have Silver Ring Value Partners, all one word.com, which is my partnership site. I also have behavioralvalueinvestor.com, where you can go, and I write an article a month at the intersection of value investing and behavioral finance, and pretty spam free, and check it out if you want.
Nice. Well, thanks again, Gary. Appreciate you sharing your wisdom, and we'll be talking soon.
Great. Well, thank you, Kirk. Really appreciate your time.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Gary. I really appreciate him coming on the show. I think, for those of you who don't know Gary, you should. He's a really bright guy. He just so happens to be from Boston, which might have something to do with it. Maybe it's something in the water, whatever. I'll just say what it is. But regardless, Gary's one of the value investors that I really value his friendship, because he's a very smart guy and we can learn a lot from him. So now we're on to the panel portion of the show. So this week we have our very own Barb Friedberg. Hey, Barb.
Hi, Kirk. Hi, Doug. Happy to be here.
Good. Well, glad to have you, Barb. This will be a good topic for you. And also we have a returning guest or panelist or whatever you want to call him, Doug Heagren. Hey, Doug.
Hey, good morning. Hey, Barb. Hey, Kirk. Thanks for having me.
Yeah, glad to have you here. So let's just dive right in. So, Barb, what were some of your takeaways from the interview?
You mean besides the fact that I love value investing?
Besides that, yes.
Okay, besides that. Well, our time may be upon us. Value investing is the theory or the practice of looking at what is the intrinsic value of a company and then trying to buy it at a fair or reasonable price. But the takeaway is there's not one way to perfectly value any company, nor is there one way to perfectly value the fair market price of that company. So Gary talked about his process, which I thought was fascinating, very interesting. He talked about how you're not going to have a winner on every stock. Been there, done that. So I think we have a lot to talk about. And I also want to touch on, Kirk, the idea that value investing has a long, long history of success. But anyone who has been in the markets between 2010 and 2020 knows it also has some epochs where it doesn't compete very well with growth investing.
Yeah, and we'll definitely get into that. So Doug, when it comes to value investing, what does that mean to you? How do you look at value investing?
Well, value investing is a tricky one because value investing is trying to find the diamonds in the rough, right? It's trying to find the ones that haven't been noticed yet, that are clearly, at least based on popular opinion, and no matter how many angles you look at it, are not priced at where they should be according to the information that's out there, right? So you're trying to find something cheaper than it should be and try to, be the specialist, the one that found the special stock that obviously has room to grow, that, that currently for some reason out there is not necessarily priced at where it could be because of bad news or whatever.
Cool. So Barb, I know you're a former portfolio manager, and when we get into this topic of growth versus value, where did you fall? I think I know where you fall, but why don't you kind of tell listeners where you fall and how you view that kind of value versus growth debate?
I have been a value investor, a value liver, not liver, the, part of the body, but the way I live is with a value mentality. Always, because I have never liked the idea of thinking I'm overpaying something, overpaying for a company, overpaying for anything. And growth is typically focusing less on objective metrics ratios like price earnings ratio, price to sales, and those type of valuation measures, and more buying based on momentum. If a stock is going up, it will continue to go up. And there's data to substantiate that. And that's more of a growth mentality. A value mentality looks at more objective measures. So figuring out what the company is really worth, looking at their debt levels, looking at their revenue versus their earnings versus the price you're going to pay for that stock. And there are a whole lot of ways to get into that. And I am way on the value side of things as a stock picker. But I'm not much of a stock picker anymore. I've merged more into an index fund passive investor, which has a lot of support behind that methodology. So in essence, really, if we're talking personally, I've got a lot of growth stocks in my portfolio by virtue of being a passive investor. So I'll give Doug and you, Kirk, a chance to weigh in.
Go ahead, Doug.
Well, Barbara, I like what you said. And in a way, I think I would summarize this as when you're looking at value, you're looking at the stuff you know, right? You kind of have information about how the company's run, about the profitability, about good news, bad news. When you think about growth is in a way playing the pure speculative game, right? We really think this is a cool company and it's got so much potential. Look at Tesla, look at Amazon years ago. These are companies that were hemorrhaging money, right? Or look at Uber, that still hemorrhages money. And ultimately, but yet for some reason that stock was still way up here. People were piling money into it because they believed in this concept, whether it's religious fervor or it's because they're using it and see it every day, kind of going back to hey, if you see it around you and it's becoming popular, it might be a good investment. But it's really, in many cases, a lot of times growth companies there's this belief that it's going to become something better. It's not based on what we can really tell about the company right now, which is by definition speculation, correct? So when we take a look at what value is, and I tend to be a believer in value too, value gives me something that I know about the company that I can hold on to, that whether it's paying a consistent dividend, whether it's already got an established position as a niche or a powerful player in a specific market. It gives you something that says, hey, this company is going to be around for a while. Now, unfortunately, again, the past couple of years, as there's been this incredible flow of money that has helped to create greater startups, and you can think, I mentioned some of those companies have gotten more and more valuable. It has, people haven't really wanted to invest necessarily in the things they know because they've been caught up in this cloud of excitement about what things could become. And so for me, sometimes boring is good, and boring is something that I can use to be able to find information about something I know is going to be there. Even may not, necessarily mean it's going to be the best returns over a period of time, but it certainly gives me something I know should be a predictable return, which I think is really important if you're trying to plan for the future.
Yeah, those are both two great ways to look at it. It's funny, I was just thinking about this as you both were talking. When you think of the growth versus value debate, I've always put myself on the side of value investing. I grew up that way. I'm a thrifty Scot. I was raised that way. Find things that are good value. And I think there's pros and cons to each. But I was just thinking, a good way to describe it is if you're a growth investor, you're really an optimist, right? You're an optimist. You're optimistic about the future. You're optimistic about where the stock's going to go, because otherwise you couldn't do it, right? It's pretty much just, full speed ahead. And a value investor, you're kind of more of a realist, or dare I say a cynic, right? You're a little bit more realistic about the world. You're looking for values. That you don't want to get into a value trap, but you certainly are looking for a good deal. And in some ways you have to be a little more realistic, because if things are cheap, they're probably cheap for a reason, right? And whether it's cheap in a bull market or cheap in a bear market. I mean, if you're cheap in a bear market, you could argue, well, okay, you could probably find some deals. But if you were trying to find a deal in pretty much 2010 to 2021, good luck, right? Because everything was elevated in terms of valuation. So I tend to favor myself more on the value side. I mean, I consider myself an optimistic cynic, optimistic about the future and cynical about the present. But I think there's a place for both, but you have to realize, which bucket you're in. We talk about this a lot in the show of know your investor psychology. If you're a value investing or trying to be a growth investor, you're probably not going to be too successful, right? And vice versa. You just have to understand how your brain is wired and what is going to be your best chance for success, because they both work, right? If you wanted to be, if you wanted to really fine tune your perspective about it, they work best during different environments. Like Barb said, value investors should do much better than growth investors in this environment. And it's certainly happening this year. And I suspect if this trend continues, like we talked about this paradigm shift in the show, if that continues, value investors most likely will have the better shake, of the investing spectrum. But, things change, right? It fluctuates from growth and value. And that's why, if you're not spending all of your waking hours investing, then, you probably want to find a balance of the two. So, there's an element to this of being smart versus being lucky. So I don't know, Doug, what are some of your thoughts on that? Because I know that, that comes up a lot with investors.
What, being smart versus being lucky? Well, I think that the majority of investment over the last, majority of investors, unfortunately, it doesn't come down to smarts, right? Because they don't really have they don't do the research, don't have the information. They don't really look at the fundamentals of companies, right? They may look at technical indicators and say, I think those are going to be, but I think one of the great ironies you just pointed out is, are you going to be a great value investor? Or are you going to be a great growth investor? Well, they've done several studies about what the predominant holdings are that people have had over the last 10 years. And, what has typically come out is that out of the 10 biggest holdings that people held, 9 of those were tech stocks, the FANG stocks being much of that, right? Facebook, Apple, Amazon, Alphabet, Google, all of those stocks. And then what was the 10th? Berkshire Hathaway, right? So they're investing in all of this growth and speculation, and then they're over here buying Warren Buffett. Well, what is Warren Buffett? He's the ultimate value investor, right? So which way were they trying to go? And that to me tells me that either they're very good at understanding diversification or they really don't understand what they were investing in the first place.
Yeah, that's a great point. So Barb, where does that come in for you? I mean, you've seen a lot over the years and certainly you've had your fair share of wins and losses like everyone else. So where does kind of the luck versus skill come in for you?
I love this conversation because at the end of 2021, everybody was a genius. Our portfolios had gone through the roof. You had to be like, I don't know. Do you know anyone that had any losses over, 2010 to 2021? I mean, on an aggregate basis? No. So are we all geniuses? Well, the research, which Vanguard is a pro at, comparing active fund management and passive fund investing, exchange traded funds or mutual funds that follow indexes, the Standard & Poor's Index, the Total World Index, international indices, those type of unmanaged indexes. And a lot of investors have got into the passive investing. And you might go, well, why? There's so many great fund managers who have stratospheric returns. That is in fact true. But if you compare on an aggregate, 60 to 70% of passive, 60% of the time, passive investing outperforms those active fund managers. So you might say, okay, well, that still gives me a shot because I've got 30 to 40% when I can go with an active manager and I can win. Yeah, that's definitely true. But think of it this way. Do those same active managers outperform every year? No, they do not. And as a matter of fact, you can look at a long history of successful active fund managers who did very well until they didn't. And so are you smart enough to either be the active stock picker or go with an active fund manager and then know when he or she's not going to do well? I mean, I hate to pick on Kathy Wood of ARC because, look, the times were with her and now they're not. But I know a lot of smart people who invested with the ARC funds and now they've lost, 50+%. So that's a perfect example of how active fund management fails to outperform over the long term. So determining who's smart and who's lucky is a very, very difficult task.
And Barb, and it's interesting because you brought up those Vanguard studies. There's actually a white paper that I read some time ago from Vanguard that actually talked about passive versus active, and actually they promoted active in certain asset classes and areas. And I think that makes a big difference too, because if you're trying to be an active investor and you're trying to invest in the well-known stocks, which again, typically, let's just use S&P 500, for example. Well, there's only 500 of those stocks to pick from, and everybody's got information about those stocks. There's really nothing under the cover that you can find. It's going to be very difficult for an active manager to be, that much smarter and that much more consistently lucky or effective in outpacing what is essentially going to be something that most people are investing in, and there isn't that much to choose from. But Vanguard actually put out, in this article that there are some asset classes that have typically done better over the long run in active, and they tend to be areas where you're going to find more volatility within the space, and you're also going to find that there's more to choose from. So, areas like bond investing. This was a much more, the actual returns of passive fixed income investing really woefully underperformed what active managers had been able to do in that space, because the buying and selling of bonds is very complex and there's lots of different types. Other areas were when you got into small cap international. I mean, if we look at the 500 US stocks, not that much to choose from. You go outside our borders and put everything in a collective of international, and now you're talking thousands upon thousands of companies around the globe to choose from. It is much more difficult to identify what's going to be good companies out there. And an index just isn't going to be able to cover that as easily as, per se, someone who's in the trenches and looking at that. So I think when you start getting into active versus passive, there's certainly timing to that and what's going on in the economy. But there's also very much track records or trends within different asset classes where one may be a better choice over the long run than the other.
Yeah, it's a great point. And just for reference, I mean, the indexing, the passive approach has certainly been around for a while. And we had a great guest on recently, Rick Ferry, talking about that approach. And I think that, we've got a lot of positive feedback in that interview. So if you guys haven't heard it, please tune in to listen to that. It was great. I think at the end of the day, it's not always that simple. It's not black and white. And I think we all like to think of the world in black and white. It's yes or no, it's black or white, it's up or down. And it's rarely the case, right? So you think of something active versus passive. Well, when did passive really start to take off? Well, it really started to take off in 2008 because portfolio managers were caught flat-footed. They didn't know what they're doing. They all of the things they thought they know about the system imploded on them. They just weren't prepared. And they said, well, I'm going to get fired if I miss the index by too much. So why don't I just buy 25% of my fund in the index? It'll help me hug it better. And then at least I won't get fired. Right. And I think a lot of fund managers thought that way because they're incentivized. It's funny because they get, if they beat the index, they get a small bonus, hey, great. You did a good job. But if you miss big on the downside, you get fired. So what's the incentive, right? The incentive is to hug the index. So you keep your job, you get a bonus here and there, you keep people happy. But if you miss, if you miss out on the upside big, great. Like you're not going to get compensated like a hedge fund would. On the downside, you certainly will get fired. So there's this career risk that happens over there, and it causes a lot of active managers to not necessarily manage the way they should or want to, but they manage towards their risk, right? And their risk is their career, right? Versus losing money. So you have to understand the why behind this. So after 2008, we had a huge influx of passive investing. And you know what? It was great because everyone just made money for the next 10 years and you didn't have to know anything. You just put your money in, let it ride, and everyone got really lucky that they were part of one of the biggest bull markets that people have ever seen in their lifetime. So in that way, it worked out really well. The problem is it doesn't always work out well during time periods that we have now. Like if you look at like 2000 to 2013 period where the market pretty much was down for 13 years and finally exceeded that 13 years after January of 2000. We might be in for another one of those periods. I don't know. I mean, I can't tell the future any more than, anyone listening to this podcast can. But at the end of the day, there are time periods where some things work better than others. And I think we just have to be mindful of which time period we are. And I think right now we're entering one of those time periods where it makes sense to be an active manager. And I think personally, value will continue to outperform, especially since interest rates or inflation is going to remain high. We'll see what interest rates do, but I speculate that interest rates are going to continue to go up just because they have to, not because anyone wants them to. So I think that'll affect the growth versus value approach. Growth tends to do well in low interest rate environments. Value tends to do well in higher interest rate environments, historically speaking. So I think all of those play to this trend towards the value investing approach. So, I think, one of the things I want to talk about here, which, Doug and I talked about in another episode is, what is value, right? So Barb, in your opinion, you look at growth versus value, we talk about this, it's growth or it's value, but when we're really coming down to define it, it's really kind of gray. Everyone's got a different opinion of what is value, right? You look at mutual funds that are value funds, they have Apple stock or they have Google in it. Is that a value stock? So, where do you draw the line of growth versus value? How do you define them?
That is a great question, Kirk. And Gary touched on that really depthfully when he was discussing his process. And he said he looks for companies that have predictable returns, that are in markets that change slowly, high barriers to entry, a big moat, which minimizes competition. And those are all great. I love ratios. I love comparing like the price to earnings, price to sales, cash flow ratios, debt ratios. And I like to, when I am analyzing stocks, and look at those compared with both the industry as well as both historical performance of the company. But the problem is, regardless of what methodology you choose, you're not going to be right all the time. And I like when he said predictable. Really? Look, I thought Gary was really smart, but after living through COVID and really living life is not predictable. There is nothing as predictable. The biggest companies today were not even in existence when I was born 100 years ago. So, the other thing investors really need to be aware of, and this is investing 101, which is investing has an element of risk. And many new investors kind of knew that, but didn't really know that until it hit them in the face. And that is, you have to know a little bit about investment history to know their booms and busts, their up and down markets. And you have to be prepared to be able to weather those types of markets and have a plan to get through them. And I know you guys are both financial advisors, so you help your clients probably more now than ever. So look, if you want to be a stock picker, choose your metrics, do your research, choose your stocks. But realize that out of every 10 stocks you choose, one or two are going to totally surprise you on the upside. One or two are going to totally surprise you on the downside in a bad way. And then the rest are going to kind of be in the middle.
Yeah, no, that's good. So, I know one thing you said, and to be fair to Gary when he's talking about predictable returns. You're right. Nothing is really predictable, but I think you can argue some are more predictable than others, right? I mean, I think there's an element to that.
Oh,
But
absolutely. Absolutely.
But I do want to point out, and I'll ask you this, Barb. I mean, all the things that he said, predictable returns, high moat, things like that, high margins, Apple qualifies, but yet I would call Apple a growth stock. Although
Well,
you can
yeah,
make the
because
argument that it's both, but
part of it is looking at the growth rate of a company, earnings per share, revenue per share, and then how much are you paying for those earnings? So, and that's the PE ratio. I know it's just one metric, and earnings can be manipulated. So it's not always 100% reliable. But if you're paying 50 PE ratio and the company's growing at 25%, Peter Lynch liked to buy companies that had a PE ratio equal to the growth rate. So according to him, you'd be paying double. So there's those metrics, but there's also then the price you pay. Because Kirk, you say this all the time. There can be a great company, but if you're paying too much for it, then you're not going to make money.
that's right. We always talk about there are no good or bad investments, only good or bad prices. So,
although there are bad investments, because there are
yes,
companies that are going down the toilet and are not going to get out.
That is very true. There are plenty of those out there. Yeah. So Doug, let me ask you. I know you and I talked about this extensively, but kind of what are your thoughts on the difference, growth, value, where that line is drawn?
Well, going back to what Barb was saying, I thought it was interesting when we talk about again, what he meant by predictability, but what Gary had described as his definition of value. I looked at about 10 different articles, some of which from Seeking Alpha, Investopedia, and a couple others, and none of which had any definition of value equal to what he had quoted. So that doesn't tell you alone that the definition of value is very arbitrary and subjective, I think, what will. I've actually found one article that was on Seeking Alpha, pondering growth versus value. And this was really interesting. A gentleman named Retired Investor had posted this, that US value had actually outperformed US growth when measured from 1972. Since 2000, the reverse had been actually true, except for mid-cap stocks. But now if you look at international data back to 1995, value is ahead of growth. But then again, that also switched since 2005. That, again, looking at those different timeframes. But what was really interesting is there was a group called Corporate Finance Institute that looked at some common parameters around pricing, risk, and cash flow to investors. And what was interesting is that pricing, investors were willing to pay for growth, maybe even overpay, under the belief that growth will continue. Value stocks experience the opposite as investors overly discount the prospects of future growth. They also talked about cash flow to investors. Again, growth, they are trying to get bigger, so they reinvest their dividends in their business. Value companies may pay higher dividends. Well, there are investors that prize those payouts. That takes funds out of the business. But what was really interesting by Corporate Finance is they actually said that growth stocks have higher metric ratios like PE, PB ratio, and earnings per share. But they also quoted that they saw growth stocks as less risky than value because their growth rate is high and increasing. The risk in value is that they failed to meet even poor market expectations. The risk and value is that they fail to meet even poor market expectations that their metrics will improve. Found that one to be a very interesting argument that I'd love to get your opinions on, because that seems to be outside of anything people have generally believed about value versus growth, that value would actually be more risky. What are your thoughts on that?
Go ahead, Barb.
I think that's fascinating. And on an intellectual level, as a really having done a lot of value investing, that is typically true. Now, a lot of value investors will look at a company that's going along swimmingly and that has a temporary upset, which will drive their price down. Like I remember Tylenol back in the day had some sort of scare, and is that J&J? I think is that owned by J&J? I'm not sure. But anyhow, so it had a price drop and then rebounded. So part of that is, well, if you can buy a growth oriented stock who's had a misstep, then you can kind of get the best of both worlds. The problem is, what if they don't recover? So there's that pool of investments. And then there are the other pool, Doug, that I think you were alluding to, which is, they're value based for a reason, because their growth is very weak, and they really don't have the growth drivers that you see in these very popular growth stocks. So there are no, easy answers. It's not a checklist of, if a company meets these criteria, A, B, C, D, then it will be a winner. And if it doesn't, it won't be a winner. And that's the challenge of stock picking. And many people like it because it's fun and you can really have success with it. Or you can go with a manager who does the work for you.
Yeah, no, I know one thing I would say about this is I like to think of investing in layers, right? I'm laughing as I say that because I just remember the Shrek video. Yeah, ogres are like onions; they have layers. But think of it this way: like investing is layers, right? A lot of people have one layer. They look at it in one lens, and that's how they see the world: growth versus value. It's one or the other. They're laser focused, and portfolio managers, especially for mutual funds who have a very clear definition for what they have to be doing, that applies quite a bit, because they don't have choice, even if they wanted to. They couldn't go all to cash. They couldn't invest from growth into international. Like, they have very clear definitions of what they can invest in. But I think of things in layers, right? So you could say, well, growth versus value, all right, which one's better? Well, you could make that argument. But then what about the macro environment? What if that changes, right? That right now it's changing. Like, we talk about the paradigm shift. What if, something else happens? Like, there's all these different layers in terms of how the market is treating certain things, and they vary widely, which is why it's so hard to pick one versus the other, because you don't know which is going to do best during which environment. I mean, you can predict it, a little bit, but in general, it's really hard because you can't tell the future. So I like to think of it in those different layers. So yes, maybe I'm a growth investor or maybe I'm a value investor, but I also have to be mindful of, the higher level there. Like, what is the U.S. economy doing? If that changes, then it'll affect my investments. What about the global economy? What about inflation? What about interest rates? So you look at all these different layers and how are they impacting your investments? I mean, if you really get into the weeds, and I'm probably just blowing everybody's mind if you haven't thought about this, but if you think about it from that level, it gets really hard to be an investor. But that's what some of the, the smarter investors out there are doing. They're looking at all these different factors and saying, how are these going to impact my investments, right? So let's say you like property casualty insurance and it's a great environment for that. Well, in a few months, we're going to have hurricane season, and that could be challenging. Did you forget about that layer? Like, that's, if you, one time a year when that comes up, all of a sudden you can roll the dice and see if they're going to lose tons of money because some big hurricane comes through. Even though they might be a good investment, they might be a good value, that changes the price quite a bit, and certainly the fundamentals. So I think it's useful to think about things not necessarily in this laser focused approach, but to open your scope a little bit. And I think you'll see that things tend to make a little bit more sense when you widen the lens and see a little bit more of the investing landscape. So, so one thing that I know comes up a lot when we're certainly in the last 10 years is growth investors tend to be, I don't want to call them gamblers because it's probably the wrong way to characterize them, but they have more of a gambling mentality, right? They're optimists. So they're willing to take a chance on things, take a little bit more risk because the reward is potentially better. So how does this come into play, Barb, in your mind when you're trying to make investments, whether you're looking at something that's borderline growth or value, or even something you say, well, I know I'm a value investor, but this this FANG stock, or whichever one it is, to me, this is really appealing. So how do you kind of balance that?
I'm so glad you asked that question, because it all gets down to diversification. And the key to successful investing, really is not picking A stock over B stock or this fund over that fund, but it comes to figuring out, first of all, what level of risk you're comfortable with and how old you are and how much money you have and how much income you have. And so balancing out, first of all, your how much of a loss can you withstand? For example, before this whole stock market, bond market decline, I did some analyses and I said, okay, let's look at an average to worst case scenario. If my stocks went down this much, my bonds, I underestimated the bonds a little, but not much, then what is my total return going to look like in a worst case scenario? And in my portfolio, I've got a whole bunch of different assets. So I've got a couple of value funds, but I also, everything's an index fund, but I've got some value funds. I've got some mid cap, small cap, international, small cap, international, real estate, etc. And all of those different asset classes theoretically behave differently, and they will offset one another. Not so much this year, but this is totally rare and unlikely to repeat forever. And so I don't abide by the idea that you have just one type of asset or you go all in one category, because as we've all seen, different sectors, different styles, they go in and out of favor. So the idea with diversification, as well as having an asset allocation that makes sense for your temperament, your risk tolerance, your age, will help you kind of weather the storms. And that's the goal. The goal of investing is to take your dollars today and make more money tomorrow, not to be the best investor in the world. Because if you're trying for that, you're 9 times out of 10 going to experience a lot of losses. So understand historically, stocks have earned, 9-10% a year over the past 90 years. Bonds have earned, 5% a year. So if you assume over many decades that those returns are going to continue, then you figure out how much risk you're comfortable with, which asset classes you feel the most comfortable with. And then you create a diversified portfolio. You can do that with a financial advisor. You can do that with an online calculator, a robo-advisor, however you want to do it. But understand what you're getting into when you invest. And if you're looking to make a quick buck, then realize you also have the chance of making a big loss, of experiencing a big loss.
Yeah, that's great, Barb. So Doug, same question to you, and then we'll get ready to wrap it up here. Is you work with a lot of individual clients, and I'm sure you see this gambling mentality a lot with them. I think it's common, it's human nature that people that have that. So how do you kind of handle that when you're talking to people with that kind of gambling mentality?
Well, that's a tough one because now we're talking about emotional management, right? But so I think there's a couple sides of this. First of all, I mean, one of the questions is, and I'll take the other side of it. Not the people that necessarily are trying to gamble, but the ones that say, well, if I invest in the stock market, that's gambling. I don't like it, right? I don't want to lose money. If you take 1940, for example, and you look at 1940, just the returns of the S&P 500 in 1940, you are looking at, before fees, a 9.7, 9.8% loss that year. Right. So in any one year, absolutely, the markets can decline, and they can decline significantly. They can decline 20, 30, 40, 50%. We've seen that. But as you had mentioned, Barb, the longer that you stay invested, I mean, again, if you play roulette over and over again, you really don't have a high anticipation of coming out ahead, right? We know that the gambling houses are making these games in their favor, and you are going to lose the longer you gamble. That's not the case in the investing. If you take a look at, if I were to take it like at the 1940 year and I go to the end of 1920 or 2021, well, year over year return before any fees, the actual year over year is 11.35% a year. Now, if you could walk into a casino and put your money on a roulette table, knowing that over the long run, the odds are that you're going to get 11.35% return every time you play, you're going to play all day long. So investing isn't gambling. But what I do caution clients on is getting this irrational exuberance about what the markets have done in recency bias. Okay. And we've talked about this before, Kirk. I love to use the saying, you know, and this comes from really the first place I heard this, to give credit where it's due, is Michael Guyette. If you don't hate something about your portfolio, you're not diversified. Okay. Because ultimately, when you are looking at your investments, when this is what happens, they see things doing well, chasing returns. This has been doing great. Why am I not getting that? Okay. And that's a great and easy conversation to have when times are good. But those people tend to also have the conversation, why am I losing so much when times are bad? A real diverse asset allocation. I remember seeing this years ago, that about 93% of performance was tied to asset allocation. The other 7% was a combination of timing, what you pick, and world events. Again, if you're going to put your smart money down on something, are you going to put it on something with a 93% chance of being correct or a 7% chance of being correct? We worry so much about these timing and events. And what is asset allocation? Asset allocation, this is where getting a little bit in the weeds, it's really understanding correlations, long-term correlations. What does correlation mean? A correlation essentially means not, you know, when one thing overperforms, how does something else compare to that? Does it tend to overperform with it? Maybe different returns, but the whole elevator is going up together, okay? Or does that thing tend to underperform during the times that thing performs? So while one elevator is going up, the other one's shifting. That's what we would call negative or reverse correlation. And then there's non-correlated. Non-correlated means as this elevator is overperforming, this other elevator is going sideways, up, down, diagonal. There is no pattern whatsoever. And so if you're looking at really building asset allocation, it's not necessarily, well, hey, I hold this stock versus this stock. Well, they're both large cap growth. They're in the same elevator. Even to a degree, small caps and mid caps. If you look at, hey, times are good, US equities tend to go up typically, you know, in a similar pattern. Well, that's not necessarily a diversification that's going to help to prevent those, problems to occur. So that means you got to pack your portfolio with things that, again, you might hate right now. And you look and say, well, why is that underperforming? It's underperforming right now because it's there to overperform at the time these other things underperform. And you've got to understand that it is good to hate something in your portfolio. Unfortunately, the emotional mentality is, well, this isn't doing as well. I want to dump it and move over here. But again, if we have a shift, a paradigm shift, a fundamental economic shift, and all of a sudden the environment is not positive for the things that you love, what's going to protect you during that time? And that's why it's important to make sure that you have the right allocation depending on your true risk tolerance. And again, the reality is people tend to be more risk adverse than risk tolerant. They just don't know that until risk hits. And again, Kirk and I, you've talked about, there's a difference between risk and volatility. Market bouncing around, that's volatility. Risk is fundamental loss. And so people tend to be more risk adverse than risk tolerant when risk actually hits. So what are you going to do to make sure that you don't have to track this and move around in time and play in that 7% space? It's going to be having the right asset allocation now. And that is going to mean you need to have the right balance of things you love and the things you hate so that you can then adjust that. And the last thing I'll say on this is you may have that right allocation of things you love and hate. Guess what? Markets move. And what typically happens is over a course of time, the things that you love during that environment are going to get better and better and better. And they're going to become a bigger portion of your portfolio. Guess what? You have to revisit that, because if, let's just say, the right place to be was 70% in this asset class, if it's overperforming, it's eventually going to become 75 and 80% of your portfolio just because it's going well. And that thing you didn't like, that thing you hated, maybe that was 30% of your portfolio, is now dropped to 25 to 20. So some people will fundamentally want to move that money out of the things that are underperforming. Mistake. But it's just as big a mistake to allow your portfolio to continue going in the same pattern. Because if you were supposed to be 70 and 30 and you are now 80 and 20, you've got to make some adjustments because you are no longer within the right asset allocation for you. And that's where it's going to take some help from professionals or a lot of research on your part to understand this at a deep level.
That's great insight. Appreciate that, Doug. So we're going to wrap it up here in the interest of time. So Barb, final thoughts, and where can people find more about you?
First, I want to say, Doug, that was really a clear explanation. I thought that was great. And final thoughts are, as we're seeing this year, markets don't always go up, they do go down. And so what you have to realize is, if you had all of the money for your home down payment savings in the stock market, in crypto, in Tesla stock, and then all of a sudden the house you wanted to buy, you had 200,000, now you have 100,000. You know, that is a lesson to remind investors that if you have money that you have earmarked for short-term needs, and I'm talking short-term like 2-4 years, it should not be in the stock market. You have to bite the bullet, keep it in cash, keep it in a CD, keep it in a money market or a very short-term bond fund, because you may risk losing a little bit of appreciation, but you won't risk losing 20 or 30% of it if the markets tank before you buy your house. So I am Barbara Friedberg. You can find me on YouTube at Barbara Friedberg Personal Finance and at Robo Advisor Pros. Bye.
Thanks for coming on, Barb. And Doug, final thoughts from you, and where can people find more about you?
Well, Barb, you made me think of something. So I have a client. So again, you can find me at procollegeplanners.com. My firm helps families get the discounts they need for college, find the right college academically, financially, and socially, and then pay for college in ways that will help them to keep more money for their retirement. And this made me think of something that you mentioned about short term, right? Argue rule of thumb, less than 5 years, keep it in cash. Well said, Barb. I have a client whose father has money in the market, in an up, and I was talking to her about, we got to pull that out because their child's going to school this year. Well, now that the market has already dropped, guess what he doesn't want to do? He's been told by his advisor, we think the bottom's here, just keep it there so it's going to come back. Hope is not a financial strategy. Okay. So ultimately, and there's more to that. When it comes to college planning, it's not just about returns, it's about the impact on financial aid. That money in there is hurting their ability to get student loans, or I'm sorry, scholarships based on need. So again, unfortunately, what happens is, just like Barb said, now the market tanked and you're like, I can get it back, right? I can get it back. So I'm going to hold tight. And all of a sudden, things don't go the way you want. You hope it's going to come back, and then it gets worse. Make the financial decisions for short-term based on what you know right now. But again, Douglas Heagren, you can find me at mergentgroup.com and also Pro College Planners. If you have any questions about college planning and getting the most money and paying for college the right way, please reach out to me.
Great. Thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.